Another question that is coming in is, what is the best method to reduce risk between currency and changing currency exchange rates?
Well, as I mentioned previously, I think the most basic and probably best hedging technique is to utilize a forward contract. Simply utilizing a forward is the most simple because you're able to quantify the exposure right off the bat and lock in your margins or your cost of product. So it's the easiest way to hedge, the least accounting friendly. Now, there are customers that obviously look at option structures, which can give customers the ability to have unlimited upside or limited upside if you use structured options, just as a range forward or a collar of some kind. But if you're a publicly traded company, you use FAS rules, it's a lot harder to measure those. And if you're a middle market or mid-sized company to a small business, it's a lot harder to work with options component once the contract matures or settles. And plus, with an option structure, especially when you're dealing with vanilla puts and calls, it can be fairly pricey because you have an upfront premium to pay for the potential upside on your exposure. So again, a forward contract is probably the most basic and best way to lock in exposure, and it locks in your margins, locks in your payables, so you know upfront what the cost is, payable or receivable structure internally.